Good morning, my dear children. Today we will be doing some exercises from accounting equation. Please watch the following video. Join with me to continue the lesson.
Every transaction has an impact on the business's resources. The resources of a business refer to its supply of goods, services, information, or expertise that allows the business to operate and grow. In accounting, the resources of a business are classified into three broad categories, namely assets, liabilities, and owner's equity. The term also refers to the three types of accounts in which a business records its transactions. Assets are what a business owns or what is owed to it. It includes items such as cash, accounts receivable, merchandise to be sold, supplies, equipment, and land. Assets also include intangible items such as patents, franchises, and copyrights. Liabilities are what the business owes to others. Some examples are payments to be made to suppliers, salaries to employees, taxes to government agencies, rent to landlords, mortgage, and loans and interest payments to financial institutions. Owner's equity is the money that the owners of the business have put into the business. It also includes the owner's claim on the assets of the business. These three accounts are referred to as the balance sheet accounts as they relate to the three key items in the balance sheet. Apart from this, we also have income and expense accounts that are related to the income statement of the business. For example, revenue from sales will go into income accounts, while expenses such as salaries paid and bills settled will go into the expense accounts. In the accounting books of the business, there will be a separate account for recording transactions for each activity. When a transaction takes place, the transaction will affect the accounts of the business. Let's take a few transactions at Web Design Inc. and see which accounts they belong to and how these accounts are affected. David has invested $10,000 of his personal money in the business. This is the owner's equity. With an inflow of $10,000, the owner's equity increases by $10,000. This money is also the cash available with the business. The cash is the asset. Then, he purchased a new laptop for $800. The laptop becomes an asset of the business. However, $800 has been spent from the available cash to buy the laptop. The balance cash available is $9,200. After a few days, David got a new order to develop a website. He received an advance of $1,000. Since he has not yet developed the website, there is a liability on the company to develop the website equivalent of $1,000. This will remain a liability till the order is executed. 1 month is now over and David has to pay the rent of $500 for the office space. Since the rent is now due, expense will be recorded and a liability will be created. When the rent is actually paid later, the liability will be reduced. Businesses exchange items of equal value, real or perceived. Imagine that an exchange is like balancing a scale. The left side goes down, that is, a service is given, and the right side reacts, that is, cash is received, to maintain the balance of the scale. Accounting uses a technique to show how a transaction changes the business's resources while maintaining a balance or showing the equal value of the exchange. This is called the accounting equation. The accounting equation is a simple tool that helps us understand how various transactions affect the asset, liability, and owner's equity accounts and how these accounts are related to each other. The accounting equation is presented as assets equal to liabilities plus owner's equity. Note that in the case of a corporation, instead of owner's equity, we have shareholders' equity as many shareholders invest money and have equity stake in the corporation. The equation will always be balanced. So, if the business has assets worth $80,000 and owner's equity of $20,000, then we can say that the liabilities are equal to $60,000. Every transaction will affect at least two of these accounts. If a transaction causes one side of the equation, assets, to increase, then the other side of the equation, liability or owner's equity, must also increase to keep the equation in balance. It is also possible that an increase in one asset causes another asset to decrease. In any case, the accounting equation will always balance. Let's take the transactions at the Web Design Inc. and see how they fit into the accounting equation. The very first transaction occurred when David invested $10,000 in the business. This $10,000 is the capital or owner's equity. In this transaction, an asset in the form of cash is created for the business. The next transaction happens when David buys a new laptop for $800. Both the laptop purchased as well as the cash paid are assets. So, in this transaction, there is an increase in one asset and a decrease in another asset. The third transaction happens when David receives a new order and along with it comes an advance of $1,000. The cash received is an asset. At the same time, since the order is not yet fulfilled, this $1,000 will be a liability.